Gold prices have been on an absolute tear lately, smashing through record highs and grabbing headlines around the world. But even as investors pile in, there's a quirky pattern on the calendar that could put the brakes on gold's momentum, and it might just catch some people off guard. Let's break down what's happening. First off, gold has been the superstar of 2024 so far. In May, we saw gold cross above $2,400 an ounce for the first time ever. That's not just a big number, it's a symbol. Gold is the asset people often turn to in times of uncertainty, and right now, uncertainty is everywhere. Inflation is still sticky, central banks are sending mixed signals about interest rates, and geopolitical tensions, from Eastern Europe to the Middle East, are keeping nerves frayed. All of that makes gold look like a safe haven, and demand has surged. But if you're thinking about jumping into gold because of all this excitement, here's something worth knowing. History shows that gold has a weird relationship with the calendar, especially when fall rolls around. There's this belief among traders that gold tends to shine brightest during the late summer months, July and August. People think of it as a seasonal trend, almost like clockwork. The theory goes that as summer ends, jewelry demand picks up in India ahead of the wedding season and major festivals like Diwali. On top of that, central banks often ramp up purchases in the second half of the year. For years, these patterns seem to hold true. But here's where things get interesting. The so-called seasonal strength doesn't show up every year. In fact, when you look at the data, September can be a tricky month for gold. Over the past decade or so, September has delivered mixed results. Sometimes gold rallies, sometimes it just fizzles out or even drops. For example, in September 2020, gold prices actually fell after reaching a record high in August. Similar patterns have played out in other years too. So why does this happen? Partly it's about expectations. When everyone expects gold to climb just because it's September, a lot of that optimism is already baked into the price. If the demand from festivals, central banks, or investors isn't as strong as hoped, or if some of the risks in the world start to fade, gold prices can stumble. Also, September often marks a turning point for the broader markets. Investors come back from summer vacations, trading volumes rise, and attention shifts to what's next for the economy and interest rates. If there's even a hint that central banks like the Federal Reserve might cut rates sooner than expected, gold can lose its shine quickly. Let's add some numbers for perspective. Over the last 20 years, gold has posted positive returns in September only about half the time. In fact, the average return for September is basically flat, around 0%. Compare that to August, which tends to deliver bigger gains. So while there's a perception that fall is golden for gold, the reality is a lot more nuanced. This up and down pattern isn't just a statistical blip. It's a reminder that markets are powered by both logic and emotion. Investors flock to gold when they're nervous, and that can push prices up in a hurry. But as soon as the fear subsides or reality catches up with expectations, those gains can evaporate just as quickly. It's a classic case of buy the rumor, sell the news. Now let's pull back and think about what could happen next. The bullish case for gold is still strong. Central banks, especially in emerging markets like China and India, have been big buyers. They're looking to diversify away from the US dollar, which makes gold look attractive. Plus, with inflation still running hotter than anyone would like, gold's reputation as an inflation hedge is front and center. That's why institutions have been adding gold to their portfolios, not just retail investors. But there are risks too. If the Federal Reserve or other central banks start cutting interest rates, the US dollar could weaken, which is usually good for gold. But if rate cuts come because the economy is slowing down sharply, investors might actually sell gold to raise cash. And if inflation finally starts to cool off, some of the urgency to buy gold could fade. There's also the wild card of changing sentiment. If the markets suddenly decide the worst is over, gold could fall out of favor fast. It's also worth remembering how quickly trends can reverse. Take 2011, for example. Gold hit a record high above $1,900 an ounce in September, but just a few months later, the price had dropped by hundreds of dollars. A similar story played out in 2020 with a big run-up, followed by a sharp retreat. So while gold's long-term track record is impressive, short-term rallies can be fragile. For everyday investors, the lesson here is pretty simple. Don't get too caught up in seasonal hype or headlines about record highs. Gold can be a smart piece of a diversified portfolio, especially if you're worried about inflation or market shocks. But it's not immune to sudden twists and turns, and September's mixed track record should serve as a reminder to stay cautious. As we head into the fall, all eyes will be on the usual suspects: interest rates, inflation data, and global tensions. Gold's story isn't over, and the next chapter could be just as dramatic as what we've seen so far this year. The real question is, will gold's September stumble show up again? Or will this be the year the precious metal breaks the mold? Only time will tell, but as always, smart investors will be watching closely and keeping their options open.